Hello and welcome back to the fixed income securities series of the Amazing. In this chapter, we will discuss the role of debt market. This is chapter 1.1. Firms need finance for their day-to-day operations. Business owners raise finance mostly using debt and equity. Debt involves borrowed money to be repaid with interest, while equity involves raising money by selling interest in the company. Debt is a charge on income for the firm, while the return on equity is an allocation of profit made by the company. Similarly, governments also borrow so that they can finance spending for development of a society and country. Borrowing at both firm and government levels can be either to fund temporary liquidity shortfall or for funding long-term asset creation. Depending upon the duration and purpose of borrowing, a variety of debt instruments can be used for raising the funds. The debt market facilitates borrowing of funds using such instruments to investors having varied risk appetite. Inherently, all debt instruments are essentially loans or IOUs with an undertaking to pay or service regular promised coupon or interest and repay the principal amount borrowed after a specific period as promised at the time of the typically fixed financial models with instruments as fixed income securities. This is chart 1.1. So here, this is the issue date of the fixed income securities. So investors pay the principal to the issuer in exchange for bonds. Then the issuer pays the regular coupons to the investor, and the issuer repays the principal at maturity. So borrowing money to finance the operations and growth of a business is kind of leverage the company takes against its equity capital. This way, the owner doesn't have to give up or dilute control of the business, but too much debt can inhibit the growth of the company, and many companies have gone bankrupt under the pressure of debt. Hence, a balanced decision on the level of leverage is imperative based on the careful assessment of pros and cons of the available financing avenues. Advantages of the debt compared to equity. So debt is a long-term source of capital for borrowers. Borrowing through a debt paper by the owner will not reduce the control of the company for the borrower. Lender of funds will have priority over equity holders only in case of bankruptcy of the company. The lender would get the promised interest rate as per the indenture of the issue as well as the principal of at the time of maturity. The lenders are different to the company made by the lenders are indifferent to the profit made by the company that is shared as dividend to the equity holders. So in case of debt, the future obligations are mostly known to the company for making the cash flow planning and repayment planning. Hence, a proper and efficient cash flow management is key to the success of debt management. Interest or the coupon to be paid on debt is tax deductible to the company as it is an expense for the company. This tax deductible reduces weighted average cost of capital for the company. Higher the marginal tax rate of the company, larger is the benefit of such tax saving. Raising large amounts of debt capital through a private placement is generally less complicated as it is sold to qualified institutional buyers, and unlike public issuance of equity, complex regulations may be avoided. For its debt obligations, the company is not required to send periodic mailings to the large number of investors, hold periodic meetings of shareholders, or seek the vote of shareholders before taking certain actions. Debt is long-term and lenders tend to be more committed than the equity holders. In the long run, debt is cheaper than equity. The return on investment for equity holders is naturally higher than the interest paid on debt financing. So, what are the disadvantages of debt compared to equity? Certain debt instruments may put restrictions on the company's core activities, and at times exclusivity clauses can harm the company in general. Unlike equity, debt must be repaid at some point in time, resulting in equity outflow. Debt repayment causes cash flows to the company, and at times the company may not be able to refinance debt or raise money from the market to repay the existing debt if the market conditions turn bad. Debt is a leverage action. High leverage can jeopardize the growth plans of the companies. High leverage may also increase the risk of default. Historically, many good companies have gone into bankruptcy due to the burden of the huge debt. Debt obligations are fixed at the time of beginning of the issuance with the future dates known to both issuers and lenders. These obligations have to be repaid irrespective of the market conditions. If repayment of debt is not properly planned, the company's usual operations may get jeopardized because of because of such debt repayment obligations. At times, unplanned cash flow causes upheaval in the working capital finance, jeopardizing production plan and operations of the company. The larger a company's debt equity ratio, the more risky is the company considered by lenders and investors. Accordingly, there is a limit to the level of debt a business can take in its balance sheet. Some form of debt, like secured debentures, require the company to create a line on the assets of the company or create sinking fund out of operational cash flows, which may be burdensome at times, specifically at the time of market stress. We will cover the next chapter in next video. That's it for now. Thank you.